Accounting equation. These are all of the accounting equations for Wild 21st editions, chapters 1 through 14. I often refer to these during the lecture notes, so I wanted you guys to have this up at the site so you can look at them. First, this is chapter 1. This is the basic accounting equation. Assets are equal to liabilities plus owner's equity. What we have is equal to what we owe and what we own. And we note that the assets are on the left side of the equation and liabilities and equity are on the right side of the equation. The left side of the equation can be primarily described as being debit-based. The assets increase with the debit. Whereas the right side of the equation can be said to be primarily credit-based or increase with a credit, and that's what the CR with the plus depicts. Now, when we look at assets, what we have, we find that there's various types of assets that we discussed in Chapter 1, different types of assets, but they are always only found on the balance sheet. So the balance sheet is only where you'll find assets. Now, let's look at liabilities. We learned about accounts payable in Chapter 1. Liabilities are also only found on the balance sheet. You will never find liabilities or asset on any other financial statement except for the balance sheet. Not so for owner's equity. You're going to find the owner equity accounts on a variety of different financial statements. So let's look at that. We have owner's capital here, which is increased with the credit, because we said owner's equity is primarily credit-based, so increases to it will be an additional credit. The owner's capital, the ending calculation, ending owner's capital will be found on two financial statements, and this is true for only this account. You will find it on the balance sheet as well as the statement of owner's equity. This is the ending calculation, the ending amount of statement of owner's equity. You will find it in both places. Also, you will find owner's withdrawals on the statement of owner's equity. They increase with a debit. So increases to owner's withdrawal are seen with a debit, and because it's in opposite to the credit, it is effectively reducing owner's capital. Please ignore this little plus there. All right, let's see what else is under owner's equity. We have revenue accounts under owner's equity, and because they increase owner's equity, we're going to say that they're credit-based and they're going to increase with a credit. Revenue and statement accounts are only found on the income statement. And then expenses. Expenses increase with a debit, which has the effect of decreasing the capital or the credit-based owner's equity, and it is also only found on the income statement. So revenue minus expenses equals net income. Revenue and expenses only found on the income statement. Owner's withdrawals only found in the statement of owner's equity. Owner's capital found both on the balance sheet and the statement of owner's equity. Next, on Chapter 2, we learned about journal entries, and so we learned about the rules of these various asset accounts. As you can see, they always belong on the balance sheet, and they're all increasing with the debit. Left side of the accounting equation. On the right side of the accounting equation, we have the balance sheet accounts for liabilities, and so liabilities, again, are only found on the balance sheet. These are all increasing with the credit, and the same as what we described earlier for Chapter 1 for the owner's equity accounts. So they primarily increase with the credit. So owner's capital, when it increases with the credit. Owner's withdrawals increase with the debit. Revenue and sales increase with the credit, and expenses increase with the debit. Chapters 3 and 4, we learned about adjusting journal entries and closing entries, and this is the first time we learned about accumulated depreciation, which is found under assets on the balance sheet. However, we said it was a contra asset account, meaning that the balances are going to be contra to the normal account balance of the associated account. So these accumulated depreciation is associated with long-term property, plant, and equipment. The example I have here is equipment. So since it's debit-based, the contra account is going to be credit-based. And then also, too, as a part of our adjusting journal entries, we learned about depreciation expense. It is treated like a normal expense and increases with the debit. Chapters 5 and 6 covered retail operations as well as inventory. So we have inventory for the first time. It's a normal balance of a debit for inventory. So looks like a normal asset, also found on the balance sheet. And we also learned about the contra sales accounts of sales discounts and sales returns and allowances. Since these are contra to the revenue account, which is primarily credit-based, these will be debit-based. And we also, for the first time, learned about cost of goods sold, which is the cost of the merchandise that we're selling. It is an expense found on the income statement and increases with the debit. Next, Chapter 7, there are no different additions to the accounting equation that we're memorizing. Primarily, this is related to cash. The new accounts are related to cash. So we have petty cash here for the first time, and it increases with the debit and is found on the balance sheet. And then we have cash over and short, which is an expense of doing business. Whether cash is over or short, it can increase or it increases with the debit, decreases with the credit, and it doesn't have a normal account balance. It can be either or. So next we have accounts receivable in Chapter 9. This is the first time we learn about allowance for doubtful accounts, a contra asset account to accounts receivable. So since accounts receivable is an asset and debit based, its contra account will be credit based. And we also learned about bad debt expense, and so it's a normal expense, so it increases with a debit. Next, we learned about long-term asset. We increased the number of different long-term assets that we looked at, and we added land. And we also looked at depreciation and amortization expense, which is an expense. It's treated like a normal expense, so it increases with the debit. And then we learned about other income and expenses on the income statement, now primarily gains and losses on asset disposals. So any losses are considered a decrease on the income statement, and consequently a decrease to owner's equity, so it will be debit based. A gain on an asset disposal would increase owner's equity. Since owner's equity is credit-based, the gain on the income statement will be credit-based. Both the loss on the asset disposal and the gain on the asset disposal will be found in the other section of the income statement. Next, we looked at current liabilities. We've run across notes payable before, and so now we're learning about interest expense. We're seeing that for the first time. It is an expense, and it is debit-based and increases with the debit. Next, we learned about corporations, so we learned about an entirely different type of entity, and we had common stock we learned about, credit-based, preferred stock, credit-based, paid-in capital in excess of par, credit-based. All of these are increasing owner's equity. We learned about treasury stock. We learned about common stock dividend distributable, which is credit-based. We learned about retained earnings for the first time, where a corporation retains its earnings, and since it's increasing owner's equity because it is essentially sales minus expenses or revenue minus expenses, increases it. So it is primarily credit-based. And then we learned that a corporation doesn't take withdrawals rather, but it gives dividends to its shareholders, and those are like withdrawals, and they are debit-based. And we also learned about dividend payable. It is a current liability. Next, we learned about long-term liabilities, and this is the last chapter I'm going to cover for additional types of accounts that we're adding. But now we have bonds payable as a long-term liability. We have the discount associated with the long-term bonds payable and the premium associated with long-term bonds payable. This is kind of a contra and an addition account. It's kind of its own little animal, but they are definitely under the balance sheet and under liabilities. And so this is an offset, the discount, the premium is in addition to the value of the bonds payable, as explained during the lecture. And then also too, we have here for the first time the loss on the bond retirement and a gain on a bond retirement. The loss increases owner's equity, so on the income statement under other revenues and expenses, it will be debit-based to effectively decrease owner's equity, and a gain which would increase owner's equity will be credit-based, effectively increasing owner's